We're doing a new project, and it involves a unit trust, and only about 5 people in the world know what a unit trust is, and you happen to be one of them. So will you work on the project? So I said, sure. And it turned out to be what turned into SPDR, and it was fascinating. And we were just hoping that we'd get $1 billion, like in 2 years maybe.
Which happened.
Yeah. And we thought, oh, we really succeeded. And then all of a sudden it started taking off, and we were completely amazed. And none of us had an idea that it would turn into an industry. We thought it was going to be a one-off product for the stock exchange. I see the blockchain affecting virtually every industry because it has the capability of changing the way we do business across the boards.
Three, two, one. We're gonna talk to SPDR Woman today. Oh my God. We're gonna talk to Kathleen Moriarty today. She's also known as SPDR Woman for her role in creating the legal framework behind the world's first and largest ETF, the SPY. But she's known for more than just that. She also worked on some really unconventional and groundbreaking ETFs. She worked on the world's first gold ETF, GLD, and she worked with the Winklevoss twins on their application for a Bitcoin ETF as well. Now, I first met Kathleen last month at a crypto conference, and she really wowed everyone in the audience with her deep industry knowledge. So I'm really excited to share some of her insights with you today. Kathleen, it is great getting to talk to you again, this time in a little bit of a longer format. I want to start from your SPDR Woman days, but actually your SPDR Woman days start a lot earlier on. They actually started when you went to law school. How did that process work?
I thought I was going to be a litigator, but I ended up really liking securities law. And so when I left law school, I decided to work in a securities law firm. And I worked in municipal bonds, and I knew nothing about municipal bonds whatsoever. And I had a client who did not do municipal bonds. He bought municipal bonds and he packaged them into something called the Unit Investment Trust, or a UIT. And I knew nothing about this. And he would call me up and say, do this, do that, do the other thing. I'd put him on hold. And I had books because we didn't have the internet. And I'd flip through these books trying to find the answers about what he was asking and then get back to him.
Pretend like you knew what he was talking about.
Pretend that I knew what he was talking about. And he had a very short temper. And so he fired me many, many times. He was actually a very nice guy, but he had a very short temper.
And you just went back to work the next day?
The first time I actually went, he was a big client. The first time I went into my head boss and I said, I want you to know, I know you're going to fire me, but I just want to tell you that Bob fired me last night. And my head boss started laughing. He goes, oh, no worries. Bob fires people all the time.
So you could come back and it was no problem. Right. But it actually ended up being very fortuitous that you were working on UITs, because that ended up translating into your work on the SPY.
Yes, that's exactly right. I ended up being asked to work on SPY because they had decided it would be a unit trust. And there are not very many people who do unit trusts. And the partner who was working on SPY knew I knew about them. And so he said, join the club. So I got involved in SPDRs that way.
And it was really because you had that expertise before.
Yes, that's right. What happened was I was at a different law firm, and a partner came up to me and he said, we're doing a new project, and it involves a unit trust, and only about 5 people in the world know what a unit trust is, and you happen to be one of them. So will you work on the project? So I said, sure. And it turned out to be what turned into SPDR, and it was fascinating. Fascinating.
So why was it that it was set up with the Unit Investment Trust? And maybe you could give us a little bit of background. So Unit Investment Trust is different from what we might say is a standard ETF.
Yeah, Unit Investment Trust is a very simple creature. It holds securities and can issue more securities, and that's about it. It can't do any kind of securities lending. It can't trade securities. It's pretty much like a lockbox, except that it can issue more shares. And therefore, it has very low fees because there aren't very many moving parts. So when the decision was made as to what kind of a creature SPDR was going to be, some people wanted to be a mutual fund because a mutual fund has all kinds of abilities that a unit trust doesn't have. So, it has securities lending, it has leverage, it has all these things. And Nate, who was the person who was
Nate
Most, who was putting everything together, said, I don't see we're not going to do anything with the S&P 500. It's going to be, the 500 securities in a box, basically. Why do we need to pay all these people to do nothing? Let's do it as a unit trust. So that's how it started.
Now, you have it as this unit trust, but in some ways that sounds like something that's immutable, that you wouldn't change. Yet
That's
the
right.
S&P 500 does change every so often.
Well, that's a very good point. The unit trust, if you are tracking an index, a unit trust will permit you to follow the index. You're not managing at all. You're simply following the index. So if S&P 500 changes, they throw 3 stocks out and put 3 new ones in, the unit trust can do that because they're not making any decisions. They're just following along.
So I want to get back into your work with Nate Most. So Nate Most was on this product development team at the
Yes.
American Stock Exchange. There was a
Yes.
2-person product development team in the 1980s.
Yes.
And then he was tasked with somehow re-engineering some sort of product that would be not necessarily susceptible to the stock market crash of 1987. And so he was looking at things that involved receipts.
That's right. And actually, he was a commodities person. He was not a securities person. And one of the things, and he did a lot of things. He traded in Copra. He traded in a lot. He had a very, very unusual background. And he was a physicist. He was a bunch of things. So he decided to look at warehouse receipts because when you buy the actual underlying commodities like cotton, you often don't deliver them immediately. You put them in a warehouse, you tag them, and then you sell the receipts for those cotton. So when you're ready to take the cotton, you can go in and tender your receipt and get the cotton, or you can sell the receipt to someone else who might want the cotton. So he was thinking of the S&P like cotton. He was thinking that it was one big blob of securities. And why couldn't there be a receipt just like a cotton receipt or a soybean receipt? So the idea was you'd have the cotton, if you will, being the S&P 500, and you'd have the receipt, which would actually trade on a stock exchange, not in the commodities world. And then if you didn't want the receipt any longer, you could tender it back and get the stocks. So that was the basic idea, except that to make it work properly, the people who could tender the stocks back, they had to be large individuals who were capable of buying like 100,000 shares at a time. So the individual trader, the individual person, would sell and buy the SPDR just like a stock. So they would sell it for money, and they wouldn't return it, and they wouldn't get the 500. They would just get the money.
Mm-hmm. But that kind of gets into the special sauce of the SPY, because creation and redemption was a huge aspect of this.
Right.
And that was something that was kind of uncharted territory beforehand,
That's
especially
right.
because you could redeem some of these stocks in kind. And so that has huge tax implications too.
Yes, and actually it was funny because nobody really thought about the tax implications.
Yeah.
And one day we were sitting there and one of the tax guys came in and he said, "Do you realize there's a very good tax effect?" And we all said no. And he said, "Well, if you do in kind under these circumstances, you don't get taxed the way you would if you did, if you didn't do that, it would be corporate gains. But it doesn't happen if you have an in-kind exchange." So it turned out to be a much better deal for the unit holder.
And that was just fortuitous.
Totally fortuitous.
Now, it's kind of curious, though, that this was set up as a unit investment trust, whereas you have other open-ended funds like Vanguard's 500, S&P 500 ETF. Why was this set up as this sort of fund?
Basically, to save cost.
Okay.
Mutual funds like Vanguard, they have a whole lot of service providers, and they can do a lot of things when they're managing their portfolio. So they can borrow, and they can leverage, and they can securities lend, and they can do all kinds of things. But there's a cost for doing that to the ultimate holder. And Nate was thinking back of the commodities and the cotton, and he thought, why do we need to have anything very complicated? We're just sticking a bunch of stocks into effectively a warehouse, and why do we need to be able to lend them or to borrow them or what have you? So that's really how came about.
And it's really that mentality that helped create it. It was really that commodities mentality that he had.
That's correct. And that was one of the great features about that working group. Everybody had a different background. And so you really got a group sense rather than just everybody being the same.
We had the Vanguard Index Fund launch for S&P 500 launch in 1976. We also had S&P 500 futures, which were seen as kind of a holy grail after a lot of legal wrangling, come to be in 1982. Did either of those pave the way for what eventually became the SPY?
Yes, I do. I think they were very important. They showed the commitment of people and the interest of people in buying the basket. Now, they weren't actually buying the actual underlying basket, but they were buying a derivative of the basket. And it showed that there was a lot of investor interest.
And it was shortly after that that you were dubbed Spider Woman.
That's right. That's right. I was dubbed Spider Woman by my legal assistant, Debbie Ferraro. She made a cartoon.
Oh, with you and the Hulk and...
Yes, me and the Hulk.
Oh, which is the SEC, I guess.
Yes, it was the SEC.
Now, this is the 25th birthday of the SPY, so
Right.
I guess in some ways, happy birthday. But that was just as of January.
That's correct.
So it's been 25 years. The SPY, what is it? It's now like $275 billion. So going from that initial $6 million in seeding to all the way $275 billion, it was quite the ways to go.
It is. It's true. And none of us, not even Nate, who was a huge optimist, not even he had that idea.
But also, this 25th birthday was supposed to be the end of its operation as well.
That's correct. We originally had the 25th year being the termination date. And about 2 years, I think, after things were going and we saw that it was being picked up by people, we thought, gee, maybe we should make it longer. So we extended out another 100 years.
So now the SPY will at least go for until 2093, is that right?
That's right, although probably somebody will amend it again and it will go out forever.
So this could, and that's specific to the unit investment trust, that it has this sort of termination date.
That's correct. A mutual fund has perpetual life.
Yeah, so if you were going back and redoing the SPY, would there be a better way to set it up such that it didn't have to keep having this weird end date?
Probably not. Probably what we do now, because the law has changed. A unit trust now can have a perpetual life also.
Okay.
So we wouldn't have had to have done that.
Oh, so now to reset up the SPY, it would be. So
Yes.
whenever it hits 100 or whatever, you can reset it up so that
Exactly.
it goes on forever.
Exactly.
But right now it is set up for about 100 years from
Correct.
now. Did you expect it to become what it became?
No.
It was initially funded with $6.5 million.
And we were just hoping that we get $1 billion, like in 2 years maybe.
Which happened.
Yeah. And we thought, oh, we really succeeded. And then all of a sudden it started taking off and we were completely amazed. And none of us had an idea that it would turn into an industry. We thought it was going to be a one-off product for the stock exchange.
There's just been an insane explosion in the number of ETFs, especially since the beginning of SPY. We now have thousands and thousands of ETFs and thousands of mutual funds. What do you see right now is the process of getting ETFs approved? It now takes about a year or so.
Yes, actually, that's about to become much quicker. Mm-hmm. The SEC, right now, to create an ETF, you have to ask permission from the SEC because it violates certain rules under the 40 Act.
So you have to get an exception.
So, right, you have to get an exception. And getting an exception is a formal process. It takes anywhere from 6 months to a year, although I did the exemption order for pro funds. It took 7 years.
Wow.
But that was because it was leverage, and that was another whole issue about, how that was going to work.
What was that like in terms of getting that leverage fund approved?
It was very, very difficult because you have several divisions of the SEC, and they don't always agree with each other. And in this case, 2 divisions didn't agree with each other. So
what did they disagree on?
They disagreed on whether or not the arbitrage was going to work properly and whether or not it was really suitable for investors, regular old investors. And
versus accredited investors.
Right. So that was part of it anyway.
Did they want it to only be accredited investors, or how would they have set that up?
Well, actually, they did want to do that. And we said, how can you have a trading vehicle that's traded on an exchange but it's only available for accredited investors?
Maybe if you had like a margin account or
Right,
something. I don't know how you would set that up.
Right. So nobody could figure out how to do that. So eventually
they caved in and said
they
it's
caved
okay.
in, but they did 3 of them, 3 different, sponsors, and then they halted them forever because they felt that all their concerns were, justified.
Oh, okay.
So that was a whole problem. But now, forgetting leverage for the minute, the SEC has finally decided to adopt a rule that would avoid the whole permission process. So if you can follow the rule, then you could launch an ETF without having to get that permission process. And if that's the case, that would cut things down quite a lot.
So it'd be kind of like a standardized form for ETFs?
That would be a standardized form. And then you would just have a prospectus, and it would be much more like issuing corporate stock. It would be much faster.
Would that necessarily be a good thing, though? I mean, suddenly you already have so many ETFs. We have more ETFs in the U.S. than stocks in the U.S.
It's true. Hard to say.
Yeah. That would make it, though, match the mutual fund process more closely, though.
That's correct. Because their mutual funds have to get permission for certain things, but they don't have to get permission to be a mutual fund. Mm-hmm. Whereas in the case of an ETF, just to be an ETF, you have to get permission.
Do you see this rule coming soon, or?
It's supposed to be coming out in the spring. Now, they tried to adopt the rule in 2006 or 2008, and then various things happened and they put it aside. So we'll see what happens.
Yeah, how do you see that changing the industry?
It would make it easier for new entrants.
Yeah.
A lot easier.
Yeah.
It's less costly and less time.
Wow. Now, your work on the SPY, did that lead into your work on GLD? Because you've worked on so many unusual products. Was it that your expertise working on uncharted territory brought you to more uncharted territory and gold?
Well, someone came to me and said, I'd like to create a gold fund. And I thought they meant like a gold futures fund or something like that. And they said, no, I want to be able to create a gold fund that actually holds the metal, like a commodities warehouse, like the cotton.
Yeah.
And I said, well, it'll be kind of interesting because the S&P is different. It holds stocks, and we don't have any ETFs that hold metal or physical things. So we had a long run with the SEC. They were very concerned about this because it really wasn't in their bailiwick. But they realized that gold has been an investment for a long, long time. They had a lot of history, backing them up. And also the actual gold market was monitored and run by the LME, which is the London Mercantile Exchange. So there were regulators, and that made them feel much, much more comfortable. So after a long period of time, we convinced the SEC that, this was, a regulated industry and that it could be okay.
Would it have been easier to just go about doing it through, let's say, gold futures? Would that have been a fairly easy process versus actually having physical gold?
That would have been a much easier process. But the person whose idea it was to create the gold felt that, like everything else, that the futures doesn't always track exactly what the underlying does. And he wanted to give people the ability to own actual gold without having to own it in coin or, little bars.
And this is the World Gold Council that was the initial impetus for creating this GLD fund.
Right.
That also started out fairly small and then has grown to this crazy amount. Within 3 days, I believe it got to 1 billion in
That's correct. The first day, actually, of trading, I was on the floor of the stock exchange, and I never saw so many people running across the floor in my life. It was just, it exploded.
Wow. And did you know at the time that this was going to be something that was groundbreaking?
No.
No. So it totally took you by surprise.
I'm not a good, predictor of things.
Yeah. In terms of redemption, I mean, was that a hard thing to set up, especially when you have physical gold? We were just talking about the S&P 500. You could get that in kind, but then suddenly now you have this gigantic gold ETF and you have to figure out how redemption works.
Well, since they were the same people, they were very large individuals who were permitted to redeem. If they wanted to, they could redeem in gold. They'd have the trustee of the vault, exchange the gold for the physical certificates. Individual investors couldn't get the gold any more than they could get the S&P.
Now, GLD is treated, the tax treatment there is that gold is a collectible, whereas for another ETF like PHYS, which is physical gold ETF, that's treated as, shares of a company. And so the tax is quite different. So the one case you have GLD, which because it's a collectible, it's treated at 28% tax, whereas when you have gains in a company, it's treated at the capital gains rate, which is 15 to 20%.
That's right.
Was there a reason in terms of setting up GLD as a collectible?
No, it was kind of the reverse of spiders, where there was a good tax result by mistake, and then this was a bad tax result by mistake. There really wasn't any way to get around it. The gold held was simply gold, and it was taxed as a collectible, and there was nothing you could do about it at that time.
So oftentimes when you're setting these things up, it's almost haphazard in terms of the tax structure. You don't necessarily know how it's going to work out at the end.
Well, usually you do now. Usually when you have a meeting, you try to think of all the things that will happen, including tax. But in that particular case, I don't think anybody was thinking about tax because we had so many other problems.
Getting the SEC to approve such a strange endeavor. And then that gets into people reading the prospectus.
Right.
Which is not necessarily, you don't have people doing that.
Not very frequently. In fact, I often go to conferences and say I'm the only person that reads the prospectus.
The one that writes it reads it, and that's about it. I mean, but that's a huge point because, maybe there's something about, the gold or GLD not having insurance on some of the bars or whatever it is, in case of a disaster. Right. Or there's all sorts of other risks in some of these ETFs that people don't necessarily know about.
Right. Now, over the years, the SEC has tried to address that question. So in the old days, a prospectus was a huge document, and it was very, very, very technical. Now, a prospectus for a mutual fund or an ETF, the first 4 or 5 pages is very succinct, and it tells you all you really need to know in terms of those kind of things. Mm-hmm. And then the rest is, all kinds of more interesting things if you care about it. But the average investor should be able to read the first 4 or 5 pages and get a good idea of what the problems or not problems are. So you don't think things are hidden in the fine print these days? If there is something big, it would probably be on those first 4 pages of the ETF. I think that's right. Now, in terms of how GLD was set up, do you think it would be set up differently had you been working on it now? Probably not. Okay. Probably would be set up the same way. Yeah. And I mean, was the biggest hurdle there just getting the SEC to say, oh, okay, there is a regulator here, that the LME, and there are regulators for the COMEX, and that makes it okay? Was that the biggest? It was of comfort to them that they had information sharing agreements with the MLE, so that if they needed to, they could go to the regulator in London and say, we want to look at your trading records. If they saw something really odd going on in the market, they have about 50 or 60 of these agreements with all kinds of regulators all over the world, and they all share information. And so they're able to monitor what's going on much more carefully than they can if they didn't have access to that information. And that kind of gets us into Bitcoin as well. Now, you got approached to work on the Winklevoss twins Bitcoin ETF. I did. Did that come as a surprise to you? I mean, I guess you've worked on all these strange products before, so that's just par for the course. Well, no, it did come as a surprise only because I knew what Bitcoin was, but I'd really never thought about putting it in an ETF. So it was a surprise. And it was also a challenge. Yeah. So what would you say was the biggest challenge there, really getting the SEC on board? Getting the SEC on board, which ultimately they are not on board. Yeah. And the biggest difference, actually the gold is a good comparison, because the gold had those regulators, and there's no regulated entity in Bitcoin. Yeah. So that poses a big problem for the SEC. And getting all the exchanges to get regulated. So right now, I mean, it's kind of the Wild West in terms of Bitcoin, because you have exchanges in all sorts of different countries and all sorts of different places. And getting them, I guess, to open their books up to the SEC is not going to happen not anytime soon, I don't think. It's interesting, though, because the SEC cited 5 main concerns recently when talking about Bitcoin. They cited valuation, they cited liquidity, they cited custody, they cited manipulation, they cited arbitrage, got all 5. So what do you think it is that they're looking at? Because they didn't talk about necessarily regulating exchanges. They talked about those 5 key features. No, I think that regulating exchanges is under those 5 concerns. I mean, that's sort of a given. And then you go on to the liquidity and the... Yeah. So really their first issue is getting the exchanges. Yes.
And then in terms of those 5, so then what's the next hurdle? What do you see as the biggest thing? Because it sounds like, I mean, at least for valuation and liquidity, that's something that time will fix.
That's right. I would think so. Although it's arbitrage, maybe. They're concerned that there's a huge, like for instance, when Korea had that 30% difference between, U.S. and Korean trading prices for Bitcoin. I mean, that was something that the SEC was like, wait a minute, how can it be that much of a huge, distinction? Yeah. So I think arbitrage might be something they'd be very concerned about.
In terms of arbitrage, how does the Bitcoin community address something like that? I mean, is that a solvable problem?
No, I don't know if it's a solvable problem by any one person or by any one thing. It'll sort itself out, I would think, over time. And I think that's part of the SEC's concern. Not that so much there are all these different issues, but that it's so new that all these things haven't shaken out yet, and so they can't tell what's really going on.
So they kind of are taking a wait-and-see approach.
I think that's right, yeah.
Before they give any sort of credence to make some sort of derivative based on...
Exactly.
But there are exchange-traded notes for Bitcoin, although those are in Europe and Sweden specifically. Do you see anything like that potentially coming here?
I have heard some people talk about it. Now the question is, part of the question is an exchange-traded note is issued by a bank. And there are banks, most banks in America won't touch Bitcoin. So the first hurdle would probably be get a bank of some size. And then you'd have to face the SEC and see what they had to say.
So no matter what happens, the SEC, if they're still skeptical on it, they're going to be skeptical of an ETF or an ETN or whatever it is that comes along. Now, what do you see as the most likely way for a Bitcoin ETF to come through? Do you see it being something maybe based on the futures, which are cash settled, or something that's based on Bitcoin with actual Bitcoin underlying it?
I think probably the futures would be the better way to go, or the fastest way to go. Still won't be fast because they're new too.
Yeah.
And the SEC wants to wait again to see how their trading works. But at least they're regulated by the CFTC, and their financial instruments. They're more like something that they're used to dealing with. Right. So I think within time that might be the first kind.
Because I remember when these futures were coming out in December of last year, and people said, "Oh, this is it. We're going to get a Bitcoin ETF," but not so fast. There's still a long ways to go.
Yeah,
even for that.
I think so.
Now, what sort of regulation is it that the SEC wants to see in the crypto space? Is it simply just getting access to the books of some of these exchanges, or is it something more than that?
Well, that's part of it, and then part of it would be being able to institute stops where the volatility would be too great. Part of it would be they would want to regulate the people who sell the Bitcoin, just like you have broker-dealers, they're all regulated. So they want regulation throughout the industry, which could be tough because, of course, Bitcoin grew out of people who didn't want to be regulated.
Right. So there's sort of a contradiction there.
Exactly.
Because basically Bitcoin is something where there's no centralized authority, but here you do have it where the SEC or people that want this sort of exchange-traded fund would have to put it into some sort of regulated box.
So it's kind of a contradiction in terms, as you say.
How long do you see this process being for the SEC to ultimately approve it?
It's probably at least a 5-year period, would be my guess.
And then how do you see this affecting the underlying Bitcoin? So actually having an exchange-traded product, because when we did see GLD start to trade, you suddenly had a whole new field of investors that got exposure to gold.
Exactly.
And I remember reading a statistic that 60 to 80% of these investors had never dealt with gold before. And so that ended up bumping up the price. Do you see this having an effect on Bitcoin's price at all?
Yes, I think the same thing would happen.
Yeah.
For the same reasons.
Yeah. Especially because Bitcoin right now is like so difficult to get a hold of.
Exactly.
Yeah.
And that was the theory with gold as well, that gold bullion is very hard to deal with, and there are storage costs, and it's hard to move around. Mm-hmm. And so with Bitcoin, it isn't hard to move around, but there are storage costs, and there's a fair procedure in getting them. So it's kind of similar to gold in that way.
And it's also tough because, there's all sorts of I would say, negative attitude around this whole space, especially because we have the ICO market, initial coin offerings,
Yes,
which have led to some problems for the SEC. So they have their hands full with Bitcoin. They also have their hands full with initial coin offerings as well.
Yes, they do.
Yeah. And so where do you see the SEC going on initial coin offerings?
I think the SEC feels that most initial coin offerings are illegal. So I think you'll start seeing more enforcement action.
Even with the Jobs Act and regulations that have come, because we have seen a loosening of regulations in terms of places being able to raise money. Do you see any legal route for an ICO to happen?
Well, there are certain things you could probably do that's very technical. You could, under certain circumstances, you might be able to get them to agree. But basically, they feel it's an investment contract. An investment contract is something that, although it doesn't look like a security, it's treated like a security for legal purposes. And that's what Bitcoin ICOs are.
Yeah. And it's funny because right now, ICOs are not necessarily bad things. I mean, so ICOs are a great way for decentralized funding of protocols, say a decentralized Twitter or something like that. But then on the other hand, you have all these fraudulent and also crazy ICOs, so things like Cream Cash or Wu-Tang Coin, or all these random coins that keep coming up. How does the SEC distinguish between good and bad?
They basically look at the underlying structure. And as I say, in most instances, they feel the underlying structure is illegal. So, but they'll look and see how the thing is constructed, how it works, what the investors' interests are, what the purpose of it is, a whole huge hodgepodge of things, and then they make a decision.
Do you see this being something you might end up working on, as long as you're in uncharted territory?
Well, I've been asked to work on some ICOs, but unfortunately, every single one of them was illegal, so we haven't been able to do it.
Wow! So when you looked at them, you thought,
the firm wouldn't
touch
agree.
This,
right?
But you would be willing to work on a legitimate ICO.
Yeah, sure.
And that would be an exciting project.
That would be an exciting project.
Yeah. It's crazy the amount of ICOs we've seen. So even though the SEC is cracking down supposedly on ICOs, I read statistics that said over $5 billion of ICOs last year, $2 billion so far this year. These are crazy numbers.
I know.
Yeah.
I know.
So does the SEC even have the resources to follow up on all these ICOs?
They're underfunded and they're understaffed. So there's a question as to how many people they can really deploy, because they have other things to do besides worry about ICOs. The question is how many people they could really get to deploy to do that. So, interesting question.
This is one of the biggest changes to capital markets in decades. Is that fair to say in terms of the ICO market and in terms of raising money?
Yes, I would say so.
Yeah. Do you see this as probably the next big frontier for capital markets and structure?
It's hard to say because what the SEC is complaining about is kind of fundamental to the structure of ICOs. So they can do them on a private basis, but that won't nearly yield the kind of money that ICOs are hoping for. So you can structure an ICO to be compliant with the law, but then you have problems because you have to cut out certain features that people like. Like, for instance, you could create an ICO that doesn't trade.
But then that's pointless.
Right. So
how does the Jobs Act fit into this, or does it fit in at all?
Well, the Jobs Act fits into it in that you can start your ICO in secret, so that when you file with the SEC, you file on a secret basis and no one knows what you're doing until very, very close to launch. But of course, that presumes that you're actually working with the SEC.
And so do you think that there's going to be some sort of reckoning right now with all these ICOs? I mean, we saw, I believe the SEC is apparently going after Overstock.com. You have all sorts of other things in the pipeline. I mean, is this just the beginning?
Well, I think the SEC typically tries to go after large people because A, is more effective, and B, it'll sort of warn smaller people about what they should be doing. So I would suspect they would continue doing that.
But you do see possibly at some point in the future there being some sort of middle ground being reached?
Yes, I think so.
Yeah.
Eventually.
And talking about the SEC having its hands full, Do you see any unintended consequences from this proliferation of esoteric derivatives that we've seen? So specifically ETFs, but maybe ETFs that aren't necessarily based on equities, but are based on more unusual structures. So something like the XIV, which tracked volatility, or was the inverse volatility, but then that's a derivative of itself because that's based on options on S&P 500 companies, which is based on S&P 500 companies.
Right.
So it's like one thing of another of another of another.
Well, first of all, you have to remember that brokers have the requirement of being suitable, or sorry, not that they're suitable, but the investments that they sell to their clients are suitable. And some of those things are not suitable for regular clients. They're too difficult to understand. They're too risky. They're too volatile. They just don't make a lot of sense. So the regulators have been trying to convince the brokers to pay a little more attention to what they're selling and to whom. On the other hand, there's also a feeling that investors don't pay enough attention and that they just sort of go with the flow. They hear something called gold ETF or whatever, and they think, oh, good, and they don't really look at it at all. And so it's a two-part process. You have to have investors paying some attention to it, as well as brokers, being careful about what they sell.
Yeah, I remember the story of someone talking about, oh, this great new stock, XIV, it's really been exploding over the past year, not necessarily even knowing what XIV was or what it was tracking at all.
Exactly.
Yeah, so that's, if there were to be some sort of, which we've seen over the past few years, some big dislocation in terms of the ETF tracking the underlying assets or whatever it is, who's accountable in that situation when you see these major dislocations?
Unless there's been fraud or manipulation or some kind of nefarious purpose, really no one is, because it's a function of the market. People freak out, they sell, they try to sell, they're selling into a falling market, and the thing just goes crazy. The market will eventually correct itself. Now, if there's fraud, that's a different story. Then you can go after that person or that group.
But in terms of dislocations, there's no one person that's responsible in the case of a market crash. There's nothing that can be done about that.
That's right. Not unless there's some kind of, bad actor that's deliberately caused the crash.
But we've seen, over the past decade, time and time again, whether it was the flash crash or in August of 2015, ETFs having that dislocation, not tracking the NAV specifically, and albeit for short periods of time. But I mean, is this just part of the structure of how they're set up that investors should come to expect, these 6 or 7 sigma events that should really only happen once in a billion years, but happen a little more frequently?
I think it's a reflection of the market. And what people forget is the market is comprised of people, and people are irrational. And so when you have irrational events going on or irrational behavior going on to a particular event, you start getting these dislocations. So I wouldn't say that the ETF caused these diversions.
But do you see any sort of domino effects? I mean, in terms of unintended consequences where one thing can trigger another, we did see with the XIV as it was getting closer to the end of the day, the ETN ended up hedging and so possibly buying more VIX futures. And so then that ended up pushing the price up.
Well, at some point you have trading halts, which will kick in and prevent the thing from going either too high or too low.
Yeah.
But short of that, not really.
Yeah. And so,
I mean, the stock market is a risky place.
Yeah. And so just you have to...
People forget that.
But yeah, I mean, you don't see necessarily some big explosion happening with ETFs in the next crisis or anything.
No, I don't see that.
How have you seen the regulatory landscape change in the past few decades that you've been working in it? How has the SEC changed? Is it more difficult now, or was it more difficult before to get some of these products approved?
It kind of goes in a parabola. It started out being very difficult. And then there was a period of time when it was, I won't say easy, but it was easier. The staff was more inclined to look at innovative products and think well of them. And then now we're back into the more negative area. So
it's become a lot tougher than it was, let's say, a decade ago.
Yes, I think so.
And so what do you think has changed over that period of time?
Politics.
Huh. And how did that work?
Well, just that, the commissioners are appointed, and they, to some extent, the SEC is one of the agencies that's pretty free of politics. But nevertheless, they're still people, and they still may have a liberal or conservative view, even though they're not being affected by particular, Republican and Democratic processes. So it depends on the composition of the commission in terms of, is it central, is it rightist, is it leftist? That's what happens.
Do you think that the financial crisis actually played a role in why we're seeing that sort of crackdown right now?
I think that was part of it, yes.
Yeah. And so that's sort of this tight regulatory landscape, and so that has implications for the ICO market, for Bitcoin ETF,
right.
all these new products
right.
that are coming down the pipeline.
Exactly.
How do you see capital markets evolving over the next decade or so?
That I couldn't tell you. I'd have to be an economist.
Well, in terms of, let's say the blockchain possibly transforming your industry.
I see the blockchain affecting virtually every industry because it has the capability of changing the way we do business across the boards. Mm-hmm. So I think that will be a huge change.
Will you still be in business?
I don't know. I'll have to figure out some way to keep myself in business.
So you think it actually might take over?
I think it will take over certain legal jobs. Yeah, I do.
Yeah.
I think there'll be mainly back office jobs, but depending on how smart contracts work out, right now they're pretty simplistic, but they could develop into something, more complicated, in which case you'd need less lawyers.
Yeah, well, you are Spider Woman, so maybe somehow
I'll
you're going to
figure out some other way.
Yeah, to get into it.
Right.
All right, Kathleen Moriarty, true trailblazer. Thank you so much for sharing your insights and giving us a little bit of a behind-the-scenes look.
Well, thank you. I really enjoyed it.
It's wonderful. We just talked to Kathleen Moriarty. She gave us some behind-the-scenes action as to what it was like when creating the SPY, as well as GLD, and how it relates to creating a Bitcoin ETF and the challenges that a Bitcoin ETF will face in front of the SEC, as well as the fact that we probably shouldn't hold our breath for a Bitcoin ETF anytime soon. She also gave us some behind-the-scenes action as to what it's like at the SEC, all from an industry insider. I hope you guys enjoyed it as much as I did.